I want to start with a number that's going to make you a little angry, and I think that's the right reaction, because once you've felt it, you'll never leave your money sitting in the wrong place again. Picture Ron and Judy walking into the big famous bank they've used for 40 years, the kind with a branch on every corner, marble floors in the lobby, and its name on a stadium. If you have $50,000 in a savings account at a bank like that right now, do you know how much interest that $50,000 earned you over the entire past year? $5, not 5,000, not 500, $5. That's it. Because those giant banks are paying an interest rate of about 1/100th of 1% on your savings. On paper, it's called 0.01%, but you and I can just call it what it is, basically nothing. Now here's what should make you sit up straight. That exact same $50,000, kept just as safely, just as accessibly, with the very same government protection behind it, could have earned you around $2,000 over that same year instead. $2,000 versus 5. For doing nothing different except keeping your cash in a smarter place. That is not a trick, it's not risky, it's not some scheme. It is simply the single most common, most expensive, most overlooked money mistake that retirees in America are making right now. And the frustrating part is that most people never see it. Nobody sends you a letter saying you're losing $2,000 a year by leaving it here. The bank certainly won't. They're delighted to hold your money for almost free. So today, I'm going to show you exactly where smart retirees actually keep their cash, and it is not the big bank down the street. We're going to walk through the real options, in plain English, exactly how safe each one is, exactly how quickly you can get your hands on your money, and roughly what each one pays right now. And I want to be crystal clear about something from the very start, because there is a lot of dangerous nonsense out there on this topic. Keeping your cash smart does not mean putting it somewhere risky. It does not mean the stock market. It does not mean crypto or some slick annuity a salesman is pushing. Everything here is boring. It's safe, and most of it is protected by the exact same government insurance as that big bank. It just pays you dozens of times more. By the end, you'll know precisely where every dollar of your cash should live and why. Let me give you a couple to follow through all of this. Call them Ron and Judy, both in their early 70s. Careful, sensible people. They've got a nice cushion of cash saved up. Some for emergencies, some for the trips they want to take, some just for peace of mind. And every dollar of it is sitting in a plain checking and savings account at the big bank they've used for 40 years, earning them almost nothing, and they have no idea. They're about to find out. Let's walk it with them. But first I have to answer the question you're probably already asking, because it's the right question. If the big banks pay basically nothing, why on earth do they get to keep so much of our money? And the answer explains this whole mess. It comes down to two things. The first is simple habit and inertia. Picture Ron and Judy driving past the same bank branch they visited for decades, the same teller desk, the same parking lot, the same logo on their debit card. That big bank has held your paycheck, your mortgage, your bills for decades. It's familiar. Moving money feels like a hassle, maybe even a little scary. And the banks know this. They are banking, quite literally, on the fact that you won't bother to move. Your loyalty and your laziness are worth billions to them. And the second reason is that those banks have enormous costs you're paying for without realizing it. All those branches on all those corners, all that marble in the lobbies, all those employees, all that advertising, that costs a fortune, and it comes out of what they could otherwise pay you in interest. They don't need to pay you a good rate, because they already have your money and they're betting you'll stay. Now, here's the key that unlocks everything else. The places that pay retirees dozens of times more interest are overwhelmingly banks too. They're just different kinds of banks. Many are online banks with no expensive branches to maintain, so they hand those savings back to you as a higher rate. Others are credit unions or the U.S. Treasury itself. The point is not banks are bad. The point is that the specific big-name banks where most people park their cash out of habit are by far the worst paying option available. And there are half a dozen places that are just as safe and pay you real money. Let me show you each one. And I'm going to organize them in a way that actually matters for you by answering the two questions that count for a retiree's cash. How fast can I get to it? And how much does it pay? Because different piles of your cash have different jobs, and the smartest thing you'll learn today isn't a single account. It's how to match the right money to the right home. Let's start with the first and most important. The one that should hold most of your everyday cash, the high-yield savings account. Here's the beautiful thing about this one. It is almost identical to the savings account you already have. It's a savings account. You put money in, you take money out. You can get to it whenever you want. There's no lockup, no penalty, nothing complicated. The only difference, the entire difference, is the interest rate. Where your big bank pays that laughable 0.01%, a high-yield savings account today pays right around 4%. Same safety, same access, roughly 400 times the interest. And I want to hammer on the safety point, because this is where people get nervous. An online bank I've never heard of? Is my money safe there? Yes, and here is exactly why. And it's the most important concept in this entire breakdown. So let me explain it properly. Picture Ron and Judy at their kitchen table, laptop open, reading the words FDIC insured on an online bank's website before they move a dollar. These accounts are protected by something called FDIC insurance. The FDIC is a U.S. government agency created back in 1933 after the Great Depression, and what it does is guarantee your deposits. If an FDIC-insured bank ever failed, completely collapsed, the government guarantees you get your money back, up to $250,000 per person, per bank. And here is the fact I most want you to remember. Since the FDIC was created more than 90 years ago, through the Great Depression, through 2008, through every crisis in between, not one single depositor has ever lost one penny of FDIC-insured money. Not one penny, ever. So the only thing you have to check, the only thing, is that the bank has that FDIC insurance. And virtually all of them do. There are nearly 4,000 FDIC-insured banks in this country, and the good high-yield ones advertise it proudly. You look for the letters FDIC, you confirm it's there, and then a brand new online bank paying you 4% is every bit as safe as the giant bank paying you nothing. Exactly as safe, backed by the exact same government guarantee. The only difference is one of them respects your money, and one of them takes advantage of your loyalty. Let me show you what this one change does for Ron and Judy. They had about $50,000 sitting in that old big bank savings account, earning them $5 a year. They moved it, one afternoon online, into a high-yield savings account at 4%. That $50,000 now earns them around $2,000 a year. Same money, same safety, same ability to grab at any time, just by moving it to a place that actually pays. $2,000 a year is a nice trip. It's a chunk of the property tax bill. It's real money, and it was theirs the whole time. They were just handing it to the bank for free. Now, the second place smart retirees keep cash is a very close cousin of the first, and it's called a money market account. And I have to pause here because there are two different things with confusingly similar names, and the difference matters enormously for your safety. So stay with me for 60 seconds. The first kind is a money market deposit account offered by a bank. This is basically a high-yield savings account that sometimes comes with check writing or a debit card attached, a little more convenient for spending. Picture Judy writing a check from a money market deposit account for a planned home repair, while the account still earns a strong rate in the background. And crucially, because it's a bank deposit account, it carries that same FDIC insurance. Fully protected. Same government guarantee. These pay competitively right up there around that 4%. And for a retiree who wants to earn a good rate but still write the occasional check out of the account, they're excellent. The second kind sounds almost the same but is different. A money market fund. Sometimes called a money market mutual fund. This is not a bank account. It's an investment you'd hold at a brokerage. Now, don't panic at the word investment, because these are considered extremely safe and stable. They invest in things like short-term government debt, and they're designed to hold their value steady. Many pay excellent rates, but here is the one honest distinction you must know. A money market fund is not FDIC insured. It's very safe, it's very stable, but it does not carry that ironclad government deposit guarantee the way a bank account does. It's a small difference in normal times, but it's a real one, and you deserve to know it. So the simple rule is this. If you want that absolute government-backed, never-lost-a-penny guarantee, stick with the bank versions, the high-yield savings, and the money market deposit account. If you're comfortable with something that's extremely safe, but technically an investment, a money market fund from a big reputable firm is a fine place too. Now you know the difference, which is more than most people walking into a bank do. The third place, and this is a favorite of retirees who like certainty, is the certificate of deposit, the CD. You've almost certainly heard of these. Your parents probably had them. And they're having a real moment right now. Here's how a CD works. In plain terms, you agree to leave a chunk of money untouched for a set period of time. 6 months, a year, 2 years, 5 years. You choose, and in exchange, the bank pays you a guaranteed locked-in interest rate for that whole stretch. Today, good CDs are paying right around 4%, sometimes a bit more. And they're FDIC insured, just like a savings account, so the safety is absolute. The magic word with a CD is locked in. With a regular savings account, the rate can drift down over time if interest rates fall. The bank can lower it whenever it wants. But when you open a CD, that rate is frozen for the entire term. So if you believe interest rates might drop in the coming years, and many people do, a CD lets you grab today's good rate and hold on to it, guaranteed, for years to come. For a retiree who wants to know exactly what they'll earn, with zero surprises, that certainty is genuinely valuable. Now, the one honest catch, and it's right there in the deal, your money is committed for the term. If you crack open a CD early and pull your money out before it matures, you'll usually pay a penalty, typically a few months of interest. It's not catastrophic, but it means you should only put money in a CD that you know you won't need until it matures. So a CD is not the place for your emergency fund. It's the place for money you've earmarked for something a year or two down the road. And there's a wonderful, simple strategy the smart folks use to get the best of both worlds, and it has a name, a CD ladder. Instead of locking all your money into one CD, you split it up. Picture Ron and Judy sitting at the dining table with 5 folders labeled 1 year, 2 years, 3 years, 4 years, and 5 years. Say you have $50,000. You put $10,000 in a 1-year CD, 10 in a 2-year, 10 in a 3-year, and so on. Then, every single year, one of them matures and comes due. So you always have money coming available, but you're also always earning those higher, locked-in, longer-term rates. It's like a staircase of cash with a new step arriving under your feet every year. Judy set one of these up with part of their savings, and now they've got money maturing predictably every 12 months, each piece earning a solid guaranteed rate, and they never feel locked out of their own money. That's a CD ladder. It's simple, it's safe, and it's exactly the kind of boring, brilliant thing that smart retirees do. The fourth place is one a lot of people have never seriously considered, and it might be the best-kept secret in safe money for retirees. This is buying U.S. Treasury bills directly from the government. Let me explain what these are because the name sounds fancier than the reality. A Treasury bill, a T-bill, is just a short-term loan you make to the United States government. You hand the government your money for a short period, anywhere from a few weeks to a year, and at the end, they pay you back with interest. That's it. Picture Ron at the kitchen table using Treasury Direct on his laptop, while Judy checks the calendar for when the T-bill matures. Here's why retirees who discover these tend to love them. First, the safety. Treasury bills are backed by the full faith and credit of the U.S. government itself, which is considered the single safest place to put money in the entire world. It's even a notch beyond FDIC insurance in a sense, because you're not relying on a bank at all, you're lending directly to the government. If the U.S. Treasury can't pay you back, we all have far bigger problems than our savings accounts. Right now, T-bills are paying somewhere in the neighborhood of 3.5% to 4%. But here's the special bonus that almost nobody knows about, and it's a real gift for retirees. The interest you earn on Treasury bills is completely exempt from state and local income taxes. Completely. If you live in a state with income tax, that's a meaningful advantage. The money you earn from a T-bill, the state can't touch. You still pay federal tax on it, but your state gets nothing. For a retiree in a higher tax state, that can make a T-bill effectively pay even more than a savings account, at the very same rate. You can buy these directly from the government through a website called Treasury Direct, or easily through any brokerage account. It sounds intimidating, but it's genuinely straightforward, and it is about as safe and as smart as parking cash gets. So those are the 4 core homes for a retiree's cash. The high-yield savings account for your everyday and emergency money. The money market account for a bit more convenience. The CD for locked-in guaranteed rates on money you won't need for a while. And Treasury bills for the ultimate government-backed safety with a tax perk on top. Every one of them boring. Every one of them safe. Every one of them paying you dozens of times what that big bank pays. Now, before I show you how to actually put this into practice, I need to spend a few minutes on the other side of this, the traps. Because when a retiree finally realizes they've been earning nothing on their cash, they often go looking for something better, and that's exactly the moment the sharks show up. So let me protect you from the 3 ways this good instinct gets turned against people. The first trap is chasing yield into risk. Somewhere out there, someone is always advertising something that pays more. 8%, 12% guaranteed. Picture Ron seeing a flashy online ad promising a huge return with no risk, while Judy looks skeptical from across the table. And I need you to burn one rule into your mind. For your cash, the safe money you can't afford to lose, anything paying dramatically more than those safe rates we discussed is not a savings account. It is an investment and it carries risk, no matter what the ad says. Real, FDIC insured, government safe cash pays roughly what everything else safe pays. Around 4% right now, give or take. If someone's promising you double that with no risk, they are either lying or they're not telling you where the risk is hiding. The whole point of your cash is that it's safe. The moment you chase a bigger number, you've stopped talking about cash and started gambling with the money that was supposed to be your bedrock. Don't do it. The second trap is the annuity pitch dressed up as a savings account. This one catches a lot of good people. Picture a free steak dinner seminar in a hotel ballroom, with retirees sitting at round tables while a smiling salesperson points to a slide that says guaranteed income. A salesperson will present a product that guarantees a nice return and sounds just like a safe place for your cash. But many of these annuities lock your money up for years, sometimes a decade, with brutal penalties to get it back out. They call them surrender charges, and they pay the salesperson a fat commission out of your money. Now, some annuities have a legitimate place in some retirement plans, and I'm not condemning all of them. But an annuity is not a savings account. It is not where you keep your accessible cash, and anyone presenting it as a simple, safe place to park money is not being straight with you. If you can't get your money back next week without a penalty, it is not cash. Full stop. And the third trap is subtler, and it's about safety in the other direction. Having too much money at a single bank. Remember that FDIC insurance covers $250,000 per person, per bank. So if you're someone who has, say, $400,000 in cash, all sitting at one bank in one account, a chunk of that is technically over the insured limit. Now, here's the good news, because the solution is elegant and simple, and it's something smart retirees do deliberately. That $250,000 limit is per person, per bank, and per ownership category, and those categories stack. Let me show you what that means for a couple. At a single bank, a husband can have an individual account insured to $250,000. The wife can have her own individual account insured to another $250,000. And then together they can have a joint account insured to $500,000, $250,000 for each of them. Add that up. At one single bank, one couple can have a full $1 million completely FDIC insured, just by structuring the accounts correctly. And if you have even more than that, you simply spread it across more than one bank, and each bank gives you a fresh set of limits. So there is never any reason to have uninsured cash sitting around. Never. It just takes a little deliberate structuring, and now you know how. All right, let me pull this all together into something you can actually act on, because knowledge you don't use is worthless, and I want this breakdown to genuinely change where your money lives. Here is the simple system the smartest retirees use, and I call it the 3-bucket approach for your cash. Every dollar of cash you have really has one of 3 jobs, and each job has an ideal home. Picture Ron and Judy at the kitchen table with 3 labeled folders in front of them. Everyday, near future, and long term. The first bucket is your everyday and emergency money, the cash you might need this week, this month, at a moment's notice, for a car repair or a medical bill or just life. This money's job is to be instantly available, so you don't chase the last little bit of interest with it. Its home is a high-yield savings account, or a small buffer in your regular checking. You want it liquid, safe, and still earning that 4% instead of nothing. Most experts suggest keeping something like 6 months to a year of expenses here as a retiree, so you never have to sell an investment in a panic. The second bucket is your near future money, cash you know you'll want in the next 1 to 5 years. The new roof, the big trip, the car you'll replace, the cushion for the next few years of spending. This money doesn't need to be available this instant, so you can earn a bit more and lock in some certainty. Its home is CDs, ideally that latter we talked about, and Treasury bills. You're trading a little bit of instant access for a guaranteed locked-in, often tax-advantaged rate. And the third bucket isn't really cash at all. It's your long-term money, the money you won't touch for many years, and that belongs in actual investments suited for growth, which is a whole other conversation for another day. The mistake so many retirees make is keeping their second bucket and even their third bucket money sitting in first bucket places. Huge sums of cash earning nothing at the big bank, money they didn't even need for years, slowly losing ground to inflation the entire time. Sorting your cash into these buckets and putting each one in its proper home is the entire game. It's not complicated, it just takes one afternoon of deciding. And since we're talking about putting the right money in the right place, this is also where some retirees start thinking beyond just cash accounts, CDs, and regular stocks and bonds. Because cash has one job, safety and access. But your longer-term retirement money has a different job. It has to help protect your purchasing power over many years, especially when inflation rises, markets get shaky, or the dollar doesn't stretch the way it used to. That doesn't mean you should panic, it doesn't mean you should gamble, and it definitely doesn't mean putting your whole retirement into one thing. But some retirees do choose to diversify a portion of their retirement savings into physical gold through a gold IRA, because they want part of their nest egg outside the usual paper asset system. So if you have money in an old 401k, IRA, or retirement account, and you've been wondering whether physical gold belongs anywhere in your retirement plan, I'll leave a link below to a free gold IRA information guide. It explains how physical gold can be held inside a retirement account, how rollovers work, what the IRS rules are, and what you should understand before moving any retirement money. You don't have to buy anything, just use it as a free educational guide so you can make a calm, informed decision for yourself. Now let me be honest and balanced, because I always want to give you the full picture and not just cheerlead. Is there anything to be said for keeping some money at your big traditional bank? Yes, actually a little. If you like walking into a branch and talking to a human being, if you want a safe deposit box, if you value having your checking and your teller and your local banker all in one familiar place, that convenience has real value. And there's nothing wrong with keeping your everyday checking account and a modest buffer right where it is. I'm not telling you to fire your bank and cut up the cards. What I'm telling you is this: don't let large amounts of savings, real money you're not using, sit in that big bank's savings account, earning 1/100th%, when moving it to a safe, insured, higher-paying home is an afternoon's work worth thousands of dollars a year. Keep the convenience. Just stop leaving thousands of dollars on the table for it. And one more honest note, because it matters, the exact interest rates I've mentioned today, the 4s and the 3.5s, those float up and down over time as the economy changes. By the time you hear this, they might be a little higher or a little lower. But here is the thing that does not change, the thing that is always true. The giant brand-name banks will almost always pay you dramatically less than the online banks, the credit unions, the CDs. And the Treasury, that gap is the constant. So don't get hung up on the exact number. Get hung up on the gap. Whatever the safe rate is at any given moment, make sure your cash is earning close to it and not the near zero the big banks hand out. Check it once a year the way you'd check the batteries in your smoke detector. That once-a-year habit is worth more than almost anything else in this breakdown. So let's come back to where we started, with that number that made you angry. $50,000, earning $5 a year at the big bank, when it could have earned $2,000. Multiply that across all the cash a careful retiree tends to keep, and across all the years of a long retirement, and you are looking at tens of thousands of dollars. Real money, your money, handed away for no reason, other than habit. Not to risk, not to a scam, not to a crash, just to inertia, just to leaving it in the wrong drawer. And here is the part I love, the part that makes this the most satisfying money fix there is. Correcting it costs you nothing. It requires no risk. You don't have to become an investor or watch the stock market or learn anything complicated. You simply move your safe money from a place that pays you nothing to a place that's every bit as safe and pays you real money. It might be the single highest return hour of work you will ever do with your money. An afternoon that can pay you thousands of dollars a year, every year, for the rest of your life. Ron and Judy did it in one Sunday afternoon at the kitchen table. They opened a high-yield savings account online, moved most of their idle cash into it, set up a small CD ladder for the money they'd earmarked for a few years out, and left just their everyday checking at the old familiar bank. It took a couple of hours, and when the first month's interest landed, more than they'd earned in years at the old place, Judy said the thing everyone says when they finally do this: "Why on earth did I wait so long?" So don't wait so long. Your cash has been working for the bank this whole time, for free. It's time you brought it home and put it to work for you. The places are safe, the move is simple, and the money, thousands of dollars of it, was always yours to keep. Now you know exactly where to keep it.